Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So we had a busy day yesterday. I was in DC doing stuff for the fund, so things are moving along. So I apologize if I look or sound tired, and my voice is a little hoarse. But you know, we had some interesting numbers today, and I think that there's a lot to discuss in terms of what happened here, what are some of the key pieces that are going to happen going forward. So when you look at the draw that we had in crude of 4.76 million, we want to look at, well, what caused that draw? Because typically this is a build period. So it's really important to look at imports, which were actually down 697,000 barrels a day. And then when you look at exports were up 724,000 barrels a day. So if you remember to last week, we were saying that we expected to get a spike in exports because we thought we were going to get back to that 2.8 million barrel a day 4-week rolling average, and this actually gets us to that target. So now we think that exports will come down a bit, but still remain elevated. But the imports was the one that was the bigger shock. It's a matter of where, because if you remember, we said that Pad 2 was going to see a little bit of a drop because there were two periods or 2 weeks of fairly sizable increases, and we expected to move back to the 5-year average before we continue to see those increase, and that did come to pass. On Pad 3 had an increase in imports, but it was fairly muted if you consider where the activity was on the run side. Pad 5, as you know, we've been saying it's been lumpy. That was down 418,000 barrels a day. So you can see how there was this big shift, which led to a fairly good number. So now when you look at runs were up 329,000 barrels a day. All of it being driven really by Pad 3. So the fact that Pad 3 had obviously had a big export number, they had a fairly muted import number of an increase of 186,000 barrels a day, but an increase in runs of 366, we got a draw that was fairly sizable. And it's important to look at where that draw really occurred, as well as when do we think that you could start to see some builds again. Now, gasoline came in with a draw of 1.65 million. That is something that is more weather related when you look at just the timing from when everybody rushed out to make sure that they could fill up ahead of the winter storm that essentially connected from Texas all the way up into the Great Lakes and hit everything in between. So a lot of people rushed, made sure they could fill up their tanks, but then empty the tanks at the retail side. Well, the roads were closed, they were iced over, so then you had that delay of getting that, essentially refilling the residential, and that created some of the what we saw today of a large spike in demand, which is what we expected to see. Because if you remember last week, we were saying on the implied demand side, we were either going to see one more move up or just a kind of a sideways move and then a gradual rollover. Instead, we did get that increase of 900,000 barrels a day in finished motor gasoline, taking us to 9.1 million. And that is, again, that refill. So if you look at just where this goes from, it goes from storage to the racks, from the racks to the trucks, from the trucks to the local gas station. And that was where we got this big shift. So we do expect to see gasoline come back up a bit, but that was one that was, again, another bright spot in today's EIA number. And then on the distillate side, distillate is continuing to draw. Diesel continues to be in a very good position. As we were saying last week, the pace of draws is slowing, and that's something that we think is going to be the case. We're still going to get draws, don't get me wrong. It's just the pace of draws is going to continue to kind of ebb, and then the comps get a bit easier as we progress through February and into March. Now, one of the things that we've been highlighting for a little over a month now is the growing differential issues that we're seeing in the market, especially when you look at what's happening with Russia. So when you look at, I think this is a great chart. I think I had it in the Econ show, or I at least had it on Insights last week. When you look at the diesel flows, the U.S. is drawing more Russian diesel to meet surging demand, especially in Pad 1. I mean, Pad 1, we're talking about something where we are, just to give you the exact number, we are 19.2 million barrels a day below the 5-year average, and there was a draw in Pad 1 of 2.81 million. Why? Because the East Coast is where we use the most heating oil. So the fact that we're talking big about what is going to happen, there's a lot of issues that we have when you look at the East Coast. One, we're importing more and more diesel. Two, we import a significant amount of Urals. Three, we import LNG into Boston. So, and where does some of that LNG come from? Yamal, Russia. So there's a lot of back and forth. But with all of that being said, with the fear of sanctions, you saw this broad disconnect that happened in the market because European refiners have essentially told their personnel it's an all stop on Urals. Do not buy Urals, buy something else. So this has created a huge divide in terms of where where you're going to make up that volume. On one hand, the refiners that were normally going to buy Urals in their normal pockets have to now turn around and scramble and buy other crudes. So you're seeing local purchasing of Fortes, different types of Brents or what different products that make up Brent. Then you've seen an increase from U.S. Imports, which again is what we were talking about over the last few weeks, is how you were going to get more crude going into the U.S. and much less going into Asia. There's also been there's offers have been pulled on Urals. There's no bid, but who likes to take advantage of no bid situations? China. So now we're actually getting some Chinese buying of Urals, which is not surprising because they like to be opportunistic. And again, this presented itself. So there's where we're getting some of these shifts, which is why we've had differentials blow out with, just to give you an idea, so dated Brent in terms of the value was at $98.20 a barrel on Monday, which is the highest since September 2014. But then when you look at just where things are shifting, on Monday, Trafigura bid for Fortes crude, one of the crudes that helps to set the dated Brent benchmark at the highest since at least 2008 without finding any willing sellers. This pushed the Fortes premium to $2.40 a barrel above dated Brent, an all-time high. And again, it's because you're looking at guys that are struggling to find cargoes and source cargoes as they're all of a sudden told, or I shouldn't say all of a sudden, over the last couple of weeks, it became more and more apparent that there was a potential for Ural sanctions, which again created a lot of these disconnects. So these are things that we're also going to go through over in segment 3, because I think it's important to look at, where does this shifting? What are the different crude grades doing? We had Saudi Arabia, which increased OSPs. We want to look at where, because it's important in terms of what is the quality of crude that is out there, which is why Iran and Venezuela become so interesting if we do sanction against Urals, because now we are going to struggle even more for the heavier barrel. We've already pushed away Venezuela. We've already pushed away Iran. Now what happens if we lose Urals? And again, this is where crude quality matters, and how are refiners going to operate if they can't source some of these specific grades. So now when we look at what has happened on a global basis, total oil and product stocks, you can see that the deficit widened from 84.8 to 94.9, essentially hugging the bottom of that cloud, which is really the low point that we've seen before. This is where, as we were saying, we expect this to go a bit sideways, start to edge up just a touch. And it's really because when you look at the product stockpiles, we continue to see some of the stockpiles growing, and it's on the light distillate, heavy resid, and residual and heavy distillate, as middle distillate continues to be the bright spot. And we'll go through the different pieces over the course of this segment and segment 3. When you look at crude stocks, land and floating, there was an increase in floating storage. But when you look at the numbers, and this is why sometimes it's always hard when you're trying to calculate where some of these things are, you're going to see that there was a big shift up in floating storage, but you have to look at how, going back through the data, they've actually revised it higher. So it just means that things that last week where Texa had said was in transit, it was actually in floating storage. So there's some shifts. So not everything looks as bad, but again, we'll go through those specifics in segment 3. Total oil product stockpiles, you can see that the deficit narrowed from 59.9 to 55.4. That's the deficit that we think is going to continue to narrow when we look at what are some of the shifts on the product side. And it's not a huge shift. As you can see, it was only a movement of about 4 million barrels. And the reason why is because the middle distillate is still the bullish side. You're still seeing draws there. You're still seeing a lot of demand for diesel. But then the other two is seeing, and so in net you're seeing an increase, but it's being driven by light distillate and by heavy distillate, which is why we get more specific when we're talking about spreads and specific products, which is why we do think that this opens up some arbitrage, which could be an interesting trade as we go into summer driving season. Now, on the crude stockpile land in total, the deficit widened from 24.9 to 39.6. And just given what we had in the U.S. today, what we had in Europe had a small build, but you're going to continue to see this come down. But it's the question of how much will the deficit widen again is going to be how much new crude is on the water, which again we'll discuss. So then when you look at shipments of gasoline into the U.S., just because it's important, dip to a 3-week low, coming in at 151.6 million barrels a day. Now, the problem with Europe is they've essentially exploded higher in terms of storage on the gasoline front, and that's something that we want to talk about more in the third segment. Now, when we look at the land storage side, you can see right at the bottom of that that cloud, the deficit widened from 56.1 to 66.3. And then when you look at where it was driven, it was west of Suez. So when you look at the U.S. and the ARA, that was where we saw the biggest increase because the deficit widened from 43.6 to 52.3. A lot of that was driven by, because U.S. had a small adjustment, but when you look at the Europe, that was where we saw some of the bigger draws. But there was also a cyber attack, which also caused some hiccups. And we do expect this to curl up a bit. Again, not coming by any means to the average, but just falling back within the low end of that cloud. Now, east of Suez, the deficit widened from 27.4 to 30.3. This is one that we would expect to adjust a bit, especially as China comes back from Lunar New Year. Things start to ramp back up, and that'll bring some of that excess floating storage that we've been talking about back on shore, and you're just going to see those barrels adjust. But we also have an increase or a spike in super tankers that are signaling China, so that some of that floating storage will be absorbed, will be increased or at least maintained over the near term as we see some of that land storage east of Suez start to increase again. Now, when you look at floating storage, the surplus widened from 37.7 to 42.4. When you look at west of Suez, the deficit widened from negative 4.6 to negative 6.1. But it was really east of Suez that saw the surplus increase from 44.2 to 45.9. And we expect east of Suez to continue to see a gradual increase. And again, nothing crazy, because if you remember what we were saying over the last few weeks, is that floating storage we think just goes sideways at this point, because there's a lot of crude out there. It's moving back and forth, and there still are issues at on the supply line getting things off the water. So that's where we're going to continue to see this remain elevated, which will keep land storage a bit artificially low, which is why we like to look at floating storage and land storage together to get a real picture of what the market looks like. So here's where we see the stock draws. So we had a draw of 4.76 million, as we were describing earlier. That's 65.2 million below the 5-year average. But when you factor in the SPR brought us down with a draw of 6.15 million. And remember, some of the stuff that is being kicked out is on loan, so some of that will come back. But it's just again, there is some of the indicators that we've been seeing. Now, the two important pieces is obviously Pad 2. Pad 2 had a draw of 2.79 million, but Cushing had another big draw of 2.8 million. Now, one of the things that we were saying, it was that as you saw refinery run rates come down, that you were going to see the Cushing draw really slow. Instead, that has not been the case. This thing has just continued to draw down, and it's a mixture of capacity constraints in terms of where things are on the import side, because imports still remain very low coming into into pad 3, which is again pulling more from Cushing, especially when you get that spike that we had in refinery run rates. Now, some of that the refinery run rate increase was due to some unplanned downtime. We had some unplanned downtime, or as I should say, refiners took some capacity down ahead of the winter storm just in case something was wrong. And it wasn't that they turned things off, it was just they reduced total flows. So that was where we saw some of that makeup come through in these numbers. So we should see some balancing act, but there was still that draw of 1.52 million in pad 3. So in total, now we're 65.2 million below the 5-year average when we're looking at commercial storage. Crude production, again, this is a calculated number. We're somewhere above 11.7 million at this point. And then, as we said in our insights, in our FSC show, we're going to continue to see some of that grind higher, especially based on commentary from Exxon, Chevron, and Conoco. On the run side, this gives you kind of a breakdown of where we were saying. So we didn't think we were going to drop below to 86.7. Instead, it did get there. But now you see this big makeup number. And one of the things that I made an error in was really not appreciating some of the run cuts that we were going to see, or I should say the reduction in capacity heading into the winter storm, and that's what we had here. So we had some of that coming back, 366,000 barrels a day in pad 3. So again, we still think that we're going to be just in the 87% range. So we should come back a bit, just a touch, but again, still staying fairly firm within this low point. And then as we get into the end of February, March, then you'll start to see a little bit of an increase depending on the location, because we actually have some turnarounds that still remain going into the end of February. So now when we look at imports, this is what we were discussing with the imports drop of 697,000 barrels a day. That is 1.118 million below the 5-year average. And most of that is being created by pad 3, which is 946,000 below the 5-year average. So we keep saying or thinking or at least seeing the boats out there that there's going to be an increase in pad 3. There was obviously some weather events which slowed that down, and when we go through pad segment 3, there was a big spike in exports coming from, I just want to make sure I get it right, because it was either gasoline or distillate. So distillate. So there was a big drop in exports of gasoline, big increase of exports in distillate. There was a big drop in propane, big increase in crude. So there was a lot of one-way traffic. There was some congestion, and now so again there you get some of that timing delay. So we will get some of those imports coming back in, some of the exports, especially on the crude side, coming down a bit. And that will balance out, which should increase storage. Not reverse the draw we had today, but at least start continuing to see that slight build on the crude side as well as the gasoline side. Now, when we look at implied demand, this is what we were talking about with that pull through. So we had that big spike of 900,000 barrels a day in gasoline. Distillate had that drop that we were discussing, about 373,000 barrels a day. Jet fuel, again, 1.4, 1.5 million. We don't think they could dip below 1.4, but it would be a snapback, same as it could jump above that 1.5. But just given the time frame in which we're in, we should see this stay right in this 1.4, 1.5 range. But then as we get into the end of February and beginning of March, which for those that have children know that is winter break, summer, spring break, and we'll start to see that pull a little bit higher. But again, very much along seasonal norms, directionally, but just at a reduced rate. Gasoline will see that drop back down just because there was that pull through to rejuvenate and refresh after the snowstorm and the ice storm that went through, and that's something that we think is going to be fairly normal. As propane continues to be a massive pull through with an increase of 181,000 barrels a day. And again, we just think that propane, for those that know us, we know that we've been bullish on the propane side, and we continue to be so. When we look at inventories, you can see that we're now dipping fairly further below 2018. And for those that that watch us, we were assuming that we were going to kind of hug that 2018 line and then start to curl up and target that 2020 level. Instead, we had that turn down. We do think that we get back to the 2018 level, but it's not going to be overnight. It could be over the course of 2 weeks, just because this was a fairly sizable draw. And the reason why I say fairly sizable is because of when it happened. It happened in February 9th, typically when we have some decent builds. So this is going to be something to watch, and it's going to all rely on what are imports doing and what are exports doing. So when we look at supply of crude, this is a bit delayed. So this will actually dip down just because we had a drop in crude and an increase in refinery utilization rates. So this will look a bit more bullish. It'll still be above that 2019, 2020 level. But again, you're still seeing that we're at the higher end of days of crude supplied, but still in a fairly good spot, or I should say comfortable spot when you're looking at days of crude supplied. Now, when we look at total U.S. commercial oil storage and products, you can see that that lower line that you may not be able to read is 2015. So we're in essentially no man's land between 2015 and 2018. Our view is that we were going to follow the rate of change of, I should say, the pace of 2018, but then start to see some of that increase going back and bringing us much closer to the 2018 line on the back of an increase in gasoline and an increase in oil. And we expected, or we still expect, to see a continuous draw in distillate. It's just the rate of change to narrow a bit. So that's something that we thought was going to bring us closer to 2018. Instead, you can see that it's actually widened. So that's something that we think will start to reverse, but again, that's going to take some time, because we're not getting back to that 2018 number in a short period. So gasoline, the one thing with the gasoline storage, and you see it in some of the other months, like you see it in 2018, you see it in 2015, you see it in 2017. There's always that one week of dips before you have kind of that gradual increase, and so we do think that builds continue in gasoline. We don't think that we've seen the last of it. It's just there was a lot of weather impacts, which again is always going to make some things a bit noisy, and that's something that we're going to see a bit more gasoline go back into storage during that time period. Plus, you also had exports still remain under pressure because the global demand for it still remains fairly lackluster, which is again something we're going to talk about in segment 3. Distillate, here's where you can see that the rate of change softened a touch. We still expect to see draws. It's just the rate of change we think softens a bit. We're not getting back to that 29-year average, which is that let's call it salmon or peach line, but it's something that it's just the comps will start to get a bit easier as the rate of change that is normal continues down. And the rate of change of draws right now softens a bit, getting us closer to the average level. Jet fuel continued to increase. Some of these, because remember, as we keep saying, kerosene and diesel can be in the same, or I should say distillate can be in the same pool, and then you have to start to separate them. So they're increasing some of the jet kerosene storage ahead of what we know is going to be an increasing demand period. When you look at the end of February, in New York, or at least for my kids, their winter break is February 21st, the week of February 21st. So that's when you start to see that pick up. And I think for those in Texas, I think it starts, March 5th, or within that time frame. So again, that's where you're going to see more vacations, things happening. So that's what they're preparing for in that picture. Here you can see the curve. So the curve continues to be strong. We essentially go through all of 2022 above 80, and then all of through 2024 above 70. But the one thing that I wanted to point to is that 65 line, because now you can see the curve is above that 65 line. So one of the things I was saying is, if you want to go after the front month because you're like, look, this is ridiculous, geopolitical risk is going to come down, there's a lot of overhang, and we were saying that you could spread it off. And this is why, because even though we've had crude still stay above, or right around 90. It's come back from 92, but it's still not a huge move. You can offset some of those potential losses if you were trying to short by buying something further down the curve. And we were saying that you'd want to stick in that December, the June and December contracts on any year is always going to have the most volume. You could do 2022, 2023, 2024, depending on some of your views. And here's why, is because you saw that whole curve shift up, which even though you're wrong on the front end, you're going to soften some of that blow by, again, gaining on the back end. So again, just some ways to look at spreads and ways to kind of play the curve, especially when you're in this backwardation period. COVID, when you look at the U.S., continues to fall. That's something that we should continue. Europe is fairly flat, as the U.K. also falls, with India. South Korea, Japan, and Thailand seeing some increases. I think I forgot Vietnam, which is actually seeing a bit of a fairly flat number. But that's something that will ebb. It'll slow down, and that'll be something that will start to see a bit more normalcy as we go through the remainder of the year. The movements are a bit tough. Indonesia is tightening some restrictions, so we're starting to see a bit more gasoline being exported and being pushed into the market. But that's something that we're going to talk about again more in segment 3. Pad 3, here you can see it's now dipped below 2020. So our view of Pad 3 was that it was going to follow the rate of change of 2020. Instead, obviously, we've dipped below. We're between where we were for 2020, 2018. This is something that we do expect to continue up, and then just follow that rate of change that we've seen in terms of where we were in both 2020 and 2018. Cushing, here you can see that pretty sizable dip. We were expecting it to start to follow that 2012 line. Instead, we got another rollover. You're pretty much in no man's land at this point. Unfortunately, based on what I'm seeing on the spreads and whatnot, you should see this increase. And famous last words, as I've been saying that for the last 4 weeks. But that's what it should do. Not to say that it will, but again, these are some of the important things as we broke that 30 number, which I know a lot of traders look at, especially when you're looking at the curve in general and those time spreads. So here, when you look at floating storage in the U.S., as we were saying, kind of bumping around the bottom end, we thought we were going to be a little bit higher in terms of that recovery. Instead, it was that gradual move up. We do expect that to increase a bit, but again, not back to the 5-year average, just further into the lower end of that cloud. Now, when we look at imports, you can see that there's normally that spike there, so we're still seasonally adjusted at an all-time low. We do think that this continues to drift up and will just be at the low end of that cloud. Now, here's where we are on Pad 2. As we were saying last week, we expected to see that drop back to the 5-year average. Went a bit through it, but it's also timing because there was that spike, and that normally happens. So here, it's just, again, we expect this to spike back up and remain above that 5-year average. And here's where we got some of that correction back up on the utilization rates. For us, it'll come down just a bit, and not by a lot. We're not talking about 2%, but maybe 50 basis points as things flatline and stay fairly close to that average 29-year number. Now, in the next segment, we're going to talk more about what's happening with the products, what do we expect for demand, and how did weather impact some of the different pieces on the heating oil side, distillate side, as well as driving on the gasoline front.